When we talk about stock market scams, most people immediately think of shady penny stocks, classic Ponzi schemes, or the occasional headline about a CEO getting arrested for insider trading. But the truth is, the biggest scam in the stock market isn't flashy. It's hidden in plain sight, and it affects almost every retail investor who buys and sells stocks thinking they're playing on a level field. The reality, the market is far from level. Most people believe the stock market is transparent, that everyone sees the same prices and has access to the same information. But that couldn't be further from the truth. Investment. Large institutions, hedge funds, and high-frequency trading firms have access to tools, data, and platforms that retail investors can only dream of. They can execute trades in milliseconds, observe patterns, and essentially predict short-term market movements long before the average investor even clicks buy. This isn't illegal. It's the system working exactly as it was designed, but it creates a huge advantage for them and a disadvantage for you. Investment. Now, one of the most controversial aspects of this hidden manipulation involves something called dark pools. Dark pools are private exchanges where institutional investors can buy or sell massive blocks of stock without revealing their intentions to the public market. On the surface, that sounds fair. They're just trying to avoid moving the market. But in reality, it's a playground for manipulation. Prices can be influenced, trends can be faked, and retail investors, who don't have access to these pools, often make decisions based on distorted information. This means that when you think you're investing wisely, you're sometimes reacting to signals that have been carefully curated to mislead you. Another major scam that continues to thrive is the modern version of pump and dump schemes. We often associate these with penny stocks, but today they can happen with more mainstream companies as well. Social media platforms, chat groups, and influencer hype can create a frenzy around a stock, driving its price up artificially. Retail investors jump in, fearing they'll miss out, and by the time the hype fades, they're left holding the bag while insiders sell off at peak prices. And the tools may have changed, tweets instead of newsletters, but the mechanics are the same. The rich and connected make money, while everyday investors take the losses. Finally, investment. Let's talk about the impact on everyday investors. The system is designed to make people feel empowered, like they can beat the market with a bit of research or intuition. But here's the hard truth. Most retail investors end up on the losing side of these hidden scams. They are outmaneuvered, missiled, and at times completely unaware of the structural disadvantages stacked against them. Investment. And it's not because they're dumb. It's because the market is built to favor those with the most information, the fastest tools, and the deepest pockets. So what's the takeaway here? Educate yourself. Don't rely on hype, rumors, or surface-level news. Understand the mechanisms that large institutions use to protect themselves and profit from the system. The stock market can still be a powerful wealth-building tool, but only if you approach it with knowledge, discipline, and a healthy dose of skepticism. Ignorance is the real scam, and it's costing everyday investors billions every year. The biggest stock market scam isn't some headline-grabbing fraud. It's the invisible systemic manipulation that keeps the deck stacked against you. Profited investment, quietly profiting insiders while most investors think they're playing a fair game. And recognizing this is the first step to taking back control of your money. ChatGPT said, most people think the stock market is a level playing field where everyone, from a small retail investor to a massive hedge fund, has access to the same prices, information, and opportunities. Investment. But the reality is far from that. The biggest manipulation in the market is often hidden, subtle, and completely legal, and it's carried out by the largest financial institutions that dominate trading. These institutions don't just buy and sell stocks. They influence prices, exploit gaps in technology, and use advanced strategies that give them an edge over everyone else. Investment. This isn't a conspiracy theory. It's the system working exactly as it was designed, but it's a system that's stacked against the average investor. One of the main ways this manipulation happens is through order flow and timing. Large institutions have access to high-frequency trading algorithms that can detect patterns and react in milliseconds faster than any human can. When a big player decides to buy or sell a stock, they can do it in a way that moves the price slightly in their favor before most investors even have a chance to react. To the outside observer, It looks like normal market fluctuations, but in reality, it's a carefully orchestrated process where the insiders know exactly how the market will react before the rest of us even see it. Another tactic is market signaling. Institutions often release large trades in fragments, creating the illusion of normal supply and demand. They might start buying a stock slowly over time, signaling to the market that they're increased interest while hiding the fact that they're the ones driving the momentum. Retail investors see this and think it's a genuine trend, and they rush in, often at higher prices. Meanwhile, the institution has already positioned itself perfectly to profit when the price inevitably adjusts. Even the tools we rely on for research can be manipulated. Analyst reports, earnings forecasts, and even mainstream financial news are often influenced by the same institutions that benefit from market movements. Subtle cues, selective information, and strategic timing can shape perception in ways that encourage retail investors to act in predictable patterns. This isn't necessarily illegal, but it's highly advantageous for those who understand the system and have the resources to exploit it. Ultimately, the lesson here is that the market isn't as fair as most people believe. Investment. It's not about whether you're smart or capable. It's about understanding the hidden advantages that big players have. Retail investors are constantly reacting to information that has already been interpreted, investment, acted upon, and sometimes manipulated by those with far greater resources. By recognizing this hidden manipulation, you can start to approach investing more strategically, avoid predictable traps, investment, and make decisions based on your own research and long-term goals rather than being influenced by forces you can't see. Knowledge, patience, and awareness are your most powerful tools in a market designed to favor the insiders. One of the most misunderstood and arguably most influential tools used by institutional investors is something called a dark pool. If you've never heard of it, a dark pool is essentially a private stock exchange where large financial players can buy and sell huge blocks of shares without anyone else knowing. Unlike public markets, where every trade is visible and prices fluctuate openly based on supply and demand, dark pools operate in secrecy. The idea is simple. If a hedge fund wants to buy 1,000,000 shares of a company, then executing that order on a public exchange would instantly push the price up, making it more expensive for them. Dark pools allow them to avoid this problem, but the consequences for retail investors are significant. But the main issue with dark pools is lack of transparency. When trades happen in a dark pool, the public market often doesn't see the full picture of what's happening behind the scenes. Investment prices can be influenced subtly because large trades in the dark pool are hidden until after they're executed, meaning the signals that retail investors rely on, like volume spikes or unusual price movements, can be misleading. Essentially, the market is reacting to partial information, investment, while insiders are already moving in ways that give them a financial edge. For someone trading on the open market, investment. This is like playing a chess game where the other player can see the whole board while you can only see half of it. Dark pools also contribute to price manipulation and market distortion. Because institutions can execute trades quietly, they can test the market, see how prices respond, and adjust their strategy without alerting the broader public. Investment. This allows them to buy shares at lower prices or sell them at higher prices while the retail crowd reacts to trends that are only partially visible. In practice, investment, it creates a system where those with the largest resources, not necessarily the best insights or judgment, control the flow of the market, leaving everyday investors to react to signals that are often intentionally vague or delayed. Another important factor is the illusion of liquidity in a public exchange investment. High trading volume is often seen as a sign of liquidity and market health, but dark pools can mask the real supply and demand dynamics, making a stock appear more stable than it really is. Retail investors see this and assume they're trading in a transparent, fair market when in fact much of the action is hidden from view. This can lead to mispriced risk, poor investment decisions, and unexpected losses when the hidden activity eventually affects the public market. The takeaway is clear: dark pools aren't illegal, and they serve a purpose for large institutions. But they create a structural disadvantage for retail investors who are unaware of how they operate. Understanding dark pools and more broadly, the hidden mechanics of how institutional players influence the market is critical for anyone serious about investment. It's not about fear, it's about awareness. The more you know about the tools and tactics you've used by insiders, the better you can protect your investments, make informed decisions, and avoid being unknowingly manipulated by a system designed to favor those with the deepest pockets and fastest technology. Even though many people think pump and dump schemes are a relic of the past, reserved only for penny stocks and shady newsletters, the truth is they're alive and thriving in modern markets, just in more sophisticated forms. The old school version was simple. A small stock would be hyped up artificially. Unsuspecting investors would buy in at inflated prices, and insiders would sell at a profit, leaving everyone else holding worthless shares. Today, the mechanics are more advanced and the platforms are different, but the principle is exactly the same, and the impact on retail investors is just as devastating. Modern pump and dump schemes often play out on social media, online forums, and even through influencers with large followings. A particular stock suddenly becomes met, and posts claiming massive potential start circulating everywhere. Videos, tweets, and viral posts create the illusion of legitimacy and momentum investment, encouraging everyday investors to rush in. The fear of missing out, or FOMO, is a powerful motivator, and it works precisely because retail investors assume that if so many people are talking about it, the opportunity must be real. What they don't realize is that the initial hype is often carefully orchestrated by people who already own the stock and plan to sell as soon as prices peak. Another way this scam has evolved is through coordinated buying activity that manipulates algorithms. Many stocks are partially influenced by trading volume and price trends. By artificially inflating these numbers, scammers create the appearance of strong demand, which triggers automatic trading systems and further draws in retail investors. This isn't just about misleading individuals. It's about exploiting the very mechanics of the market itself, turning technology into a tool for manipulation. What makes these schemes especially dangerous today is that they aren't limited to obscure low-priced stocks. In some cases, even larger or mid-cap companies can experience short-term hype-driven spikes that benefit insiders. Retail investors see the price rising and assume the growth is natural when in reality, it's being orchestrated for profit by those who understand the market's vulnerabilities. By the time the broader public recognizes what's happening, prices have already crashed, leaving ordinary investors to absorb the losses. The psychological aspect of modern pump and dump schemes cannot be underestimated. Social proof, urgency, and the illusion of opportunity create a perfect storm for emotional decision-making. Many investors don't even realize that they're being manipulated. They believe they're making smart choices based on available information, when in fact they are reacting to signals deliberately designed to mislead. Awareness of these tactics is the first step in avoiding them. Ultimately, understanding the prevalence of modern pump and dump schemes highlights a broader truth. The market isn't just about numbers and trends. It's about people, psychology, and influence. Retail investors who fail to recognize these dynamics are at a structural disadvantage. By learning to question hype, verify information, and think independently, you can protect yourself from being caught in these schemes. The key is to invest based on solid fundamentals and long-term strategy rather than short-term trends created by manipulation. Knowledge, patience, and skepticism are your greatest allies against a system that is constantly being exploited for profit at the expense of the uninformed. The harshest reality of all this hidden market manipulation is its effect on everyday investors. Most retail investors enter the stock market with optimism, armed with basic research, intuition, or tips from friends and media. They believe that with a bit of diligence, and they can grow their wealth and achieve financial freedom. But the system isn't designed to be fair to them. Every day, ordinary investors are up against institutional players with faster technology, deeper insights, and strategic advantages that are virtually impossible to match. This creates a structural imbalance that most people don't even realize exists until it's too late. The first impact is financial loss. Whether it's through hidden manipulation, dark pool activity, or social media-driven hype, retail investors frequently buy high and sell low, often at the worst possible times. They react to trends, rumors, or incomplete information, while insiders have already positioned themselves to profit from those reactions. This isn't a reflection of their intelligence or effort. It's simply the nature of the system. The retail investor, lacking access to advanced tools or real-time insider knowledge, is consistently placed in a reactive position, which inevitably leads to losses over time if these patterns continue. Another significant impact is psychological stress. Losing money in the stock market can be emotionally draining, especially when it's not due to careless decisions, but to forces beyond one's control. Investment. Many investors experience anxiety, frustration, and even self-doubt at questioning their judgment or ability to understand the market. Over time, this can lead to paralysis, where investors are too afraid to make decisions, and or worse, they chase returns impulsively, trying to make back losses. This cycle can compound financial damage and erode confidence in investing altogether. Beyond personal loss, investment, there's a broader opportunity cost. Retail investors often spend months or years trying to catch up to institutional knowledge, research, and strategies, all while earning modest returns at best. Meanwhile, the system rewards those with scale, speed, and information asymmetry. This means that ordinary investors are effectively paying a hidden fee to the insiders, not in explicit charges, but in missed gains and manipulated outcomes. The same money that could have grown steadily over time is instead siphoned off, leaving the everyday investor behind. Finally, investment. The educational gap reinforces the disadvantage. Most retail investors don't have the background to understand the intricacies of dark pools, high-frequency trading, or algorithmic market behavior. They are taught basic principles: buy low, sell high, diversify. But the real game involves strategies and mechanisms invisible to the casual observer. Without awareness of these hidden dynamics, investment, it's almost impossible to compete on equal footing. The takeaway is sobering but empowering. Recognizing that the market is structured this way allows everyday investors to adjust their approach. Success in investing doesn't require trying to beat the insiders at their own game. It requires discipline, long-term strategy, and an understanding of the systemic advantages others have. By learning, observing, investment, making informed decisions based on fundamentals rather than hype, retail investors can protect their capital and even thrive despite these inherent disadvantages. Awareness is the first step toward leveling the playing field, and it's the difference between being a passive participant in a system designed to favor the few and an informed investor who navigates it with confidence and purpose.